Welcome back. Well, as promised, let's get straight to the stock of the morning. In fact, Jana Small Finance Bank, those numbers look quite good. The street likes it. The stock is up close to 17%. To help us out with how was the past quarter and what's the way ahead, we're joined by Mr. Ajay Kanwal, who's the managing director of the company. Hi, Mr. Kanwal. It's a good day to have you in the studio. You know, the stock price has moved up. The street clearly likes what you've delivered. But let's look at the way ahead. What kind of growth guidance can you give us for the coming year? How do you see the book mix evolve? And what does that mean in terms of margins?
Okay, so morning to you, Nigel and Mangalam. I think I should come here more often.
Always welcome.
Absolutely. I mean, the stock is doing very well today. So a few things. So I'll just do a recap of where the numbers are. Mm-hmm. So we have declared roughly about 667 crores as profit for last year. Mm-hmm. It's up 162%.
Right.
And if I tell you what the drivers are, it'll give you a good sense of what next year looks like.
Okay.
So the asset growth has been 25%. Secured assets have reached 60%. Now, both are relevant because we as a bank began from a microfinance background 6 years ago, and now we moved to 60%. That will be a secular growth for next year also, which is secured growth, has to go beyond 60, that's for sure. On the liability side, we have grown 38%. So probably few exceptional banks where the liability growth exceeds the asset growth. Right. The common question is, what is your CASA? So I will answer it upfront. It's 20%. And we grew 35% on CASA. But because deposit book grew so fast, we kind of flattish it. Then the last piece, most important, is what's your book quality? So gross NPA at 2%, net NPA at 0.5%. And PCR, which was at 35% last year, we've taken it to 74% this year. So clearly from that angle also, we've tried to make sure that while the profits are good, we really wanted to invest and make sure that on a good day, be prepared for if and when something.
So you've increased basically business on all parameters, like you said. Your assets, liabilities have grown. Liabilities are a tad faster than the assets. Provisions have improved as well, and as has the asset quality. The question is then, what do you grow at for the next few years? Because 25% is what you've done.
Yeah.
Going forward, what's sustainable?
I would be like comfortable doing the 20% number as a forward guidance.
Okay.
What we put in our analyst presentation, which has gone live on the web last evening.
Oh, okay.
We would do a PAT of 30 to 40% growth.
Okay.
That's what we would expect. Importantly is ROA around 2, ROE around 20.
Got it.
So fundamentally, even if I grow not 20, but I grow 19, that's my preference. But I really want to make sure it is secured assets. And we maintain ROA and ROEs.
So with this focus on secured assets, will it come at the cost of yields? Because the unsecured book could give you better yields. So give us a couple of numbers. What will the NIMs look like? Because if you're going to focus more on the secured book and the cost of deposits will go up, will that put pressure on NIMs? If yes, what should your NIMs be?
Okay, so that's a good question, Nigel. So one is 6 years ago when we started this transition, we have turned 60% secured. And so my current NIM is already baked in with 60% secured.
Yes.
It's at 8%.
Correct.
And 8% also has an increase of cost of funds during last year, which has also been high. So, but if you take last year's NIM was 7.8, we are closing this year at 8.
Okay.
So we have managed to maintain NIMs.
Yes.
That's fine. Now, if 60%, let's say hypothetically goes up to 80%, which would be a good secured number to have, then the NIMs would drop by 50 basis points.
Okay.
But if CASA, which is at 20, improves to 30 in the same time duration, then the NIMs will drop by 30 basis points.
Got it.
Now, absolutely, so NIMs have to drop as you turn secured. But on the flip side, you do get a cost drop.
Yes.
Because secured asset is a lower cost income business. And second, you become a very resilient. See, our bigger interest is we should be a predictable, resilient retail business.
Is your bigger interest, the larger interest, to be a universal bank? Because, the RBI has released those guidelines, and what of those boxes do you tick?
So absolutely yes, all of us should yearn to be a universal bank. We tick all the boxes. The one which we have a year to go is the gross NPA and net NPA, which has to be at 2 and 1 respectively. We meet that this financial year, the results we have declared. We have one more year to make sure that we stay within the boundary line.
You have a target for
So
NPA
maybe by 2026, you'll be on your way to a universal bank?
Yeah, so we would like to apply next year.
Yes.
After we declare our financial results. And yeah, it gives us 1 year to prepare.
What is the guesstimate? How long will it take?
I have no idea, I must admit, but I suspect that since we are a scheduled commercial bank for the last 6 years and the regulator and the committee which will look at knows us well enough. So yes,
Apologies if I missed it, but if you could give us that NIMS number, you told us, you gave us the equations and how things move. But if you had to give me a guidance for this year, what will it be? Last year, as you said, it's closer to 8%.
So the results we declare is 8%.
Yes.
I think we should stay in the same range.
Okay. And what about, the micro LAP and affordable housing bits of your portfolio? Because while secured has been growing, these two are also the ones which have been growing much faster than the overall book. So what proportion of your book would grow faster than the 20% and how much of that would be lower than the 20%?
So, Mangalam, absolutely it's a fair one, which is the way we've always done it for the last 6 years is our unsecured, if you take a 6-year CAGR, it's 3%.
Okay.
I can't give you a CAGR on secured because it's infinite because we hardly had a business. But if you take a 3-year CAGR on secured, which is micro LAP and affordable housing that you mentioned, we're growing in the 50% odd.
Okay.
Now, why we're growing 50% is very simple. See, as when we started the bank 6 years ago, we were present in 180 cities, we had 650 branches. So we had customer base, we had branch, we had brand, we had collections, we knew the geographies. We just didn't have the product for the customers.
Yeah.
So for us to scale up is much simpler because you're really not growing geographically.
Right.
You're really already geographically present. You're just making sure that the customers are serviced with the products you have as a bank, whether it is savings account, current account, or affordable housing, micro LAP, gold, two-wheelers.
Correct. Okay, all right. It's been good speaking to you, Mr. Kanwal. Thanks a lot for coming down.
Thank
you. It's been good speaking to you here in the studio. Sometimes maybe the numbers will be a little bit dodgy as well, but we request you to come to the studio even at that point of time. For the time being, we'll hold you to the numbers that you have given. So that was the management there, Mr. Kanwal, sounding extremely confident.